Well, we really do need to keep it in perspective by looking at the last 2 weeks of trading. So the market had really rebounded from a very shallow pullback and a very speedy short-term oversold condition. And with that rebound, we did see a lot of breakouts. So the breakout in particular in the S&P 500 is really still pending confirmation. The S&P is now at proving ground on its chart. But I would say one day does not make a reversal, and that we need to judge next week's action to determine if these breakouts are real or if they were false.
Barry, a big factor today has been the inverted yield curve. Is that something that concerns you as to what it means for the equity market?
Not particularly. I think there's been a number of false positives with the yield curve in the past, 1966, 1995, 2005. And there's an overarching thesis around this, which is since the mid-2000s, nominal 10-year Treasury yields have been consistently below nominal GDP. That's not the condition that persisted from World War II until that time. So there's a lot less information content in the back end of the bond market. I'd furthermore add that, fading the Fed worked beautifully in December. It was 3 days of a 6% equity market sell-off following the December Fed meeting, and then that was the dead lows. I think the same thing is occurring with bond yields this go around. There's a couple things going on with bond yields that people missed as well. One is the very back end of the curve, where the Fed is less of a player, is actually steepening. Fives bonds, or 5s 30s, has been steepening sharply, and 2s 10s, 2-year forward, the forward curves is steepening as well. And the more important thing that's going on is vol is going up as rates go down. This is the condition that persisted before the crisis. When the Fed really increased the size of their portfolio dramatically, they drove down rates and vol at the same time. The thing that investors missed with what the Fed announced on Wednesday, they didn't guarantee, they didn't go back to forward guidance and say they weren't going to tighten rates for the whole of the year. They did say that they want to get completely out of their mortgage portfolio. If they get they'll never make it, but if they got completely out of their mortgage portfolio, that would reintroduce the single biggest source of interest rate risk, which is mortgage prepayment risk, back to the private sector that would have to hedge it from the Fed that doesn't. So the seeds of a bond market sell-off, and in fact, bank profitability as mortgage spreads widen out. And by the way, Mark Calabria is going to get confirmed as head of the FHFA and further lessen Fannie and Freddie's role in the mortgage market. That's actually a big bank positive. So for me, selling treasuries here and buying bank stocks is the trade investors ought to be thinking about out of this overreaction to the Fed meeting.